The Property Bulletin by London Property, the home of superprime.
As spring 2025 unfolds across London, a quiet revolution in the city's property landscape is making headlines. Indian buyers have overtaken native Brits as the largest group of property owners in the capital. According to developer Barratt London, Indian nationals, including residents, non-resident Indians, and families relocating for education, are now the dominant demographic investing in London real estate, especially in 1 to 3 bedroom flats priced between £290,000 and £450,000. What we're witnessing is unprecedented in London's modern history, says property analyst Emma Richardson. Spring always brings activity, but this season has amplified a trend that's been growing for years. Beyond numbers, the trend carries historic resonance. Social media has been quick to point out the irony. Citizens of a country once ruled by Britain are now key players in its prime real estate market. Spring 2025 marks not just a seasonal change, but a symbolic turning point in global economic influence, notes a London-based property consultant. Indian investors are showing clear preferences in their London property pursuits. Prime areas like Mayfair, Marylebone and central London. Modern developments with strong rental yield potential. Proximity to top schools and universities. Green spaces and outdoor features, especially desirable in spring. Indian investors are increasingly sophisticated, says Marcus Bennett of London Property Partners. They're targeting areas with lifestyle appeal and long-term value. This movement reflects a broader diversification of wealth among India's growing high-net-worth class. London remains a top destination for its blend of stability, status and education. Analysts expect this momentum to continue through 2025, especially as families prepare for the next academic year. A growing number of Indian buyers are also prioritising eco-conscious properties with strong sustainability credentials, a sign of shifting values and long-term thinking. As London blooms this spring, so does a new era in its global property market, one that reflects a deeper transformation in economic power, cultural exchange, and investment vision. Finland has once again been crowned the happiest country in the world for the 8th year running, while the UK has slipped to 23rd, behind Germany, Mexico, and even the UAE. So what makes Finland so happy, and why is the UK falling behind? According to Oxford University's World Happiness Report, key differences in work culture, cost of living, wealth equality, and social trust may explain the growing gap. Finns finish work by 4 p.m, enjoy generous parental leave, 23 weeks per parent, and rarely work unpaid overtime. Compare that to the UK's 2 weeks for fathers, 39 paid weeks for mothers, often at low rates, and a culture of hustle over health. Finnish employers care more about their staff, and it shows, says Kautan Kelly, a Cardiff native now living in Tampere. UK expats in Finland report lower living costs, especially in housing and transport. A mortgage on a 3-bed home outside Helsinki is cheaper than renting a 1-bed near London. Finland used to feel expensive, now the UK feels extortionate, says Darren Trofimchuk, who moved back to Kent but has left his family behind for financial reasons. In Finland, the average cost of property is £2,174 per square metre for resale homes. In the UK, it's £2,857 per square metre, based on average floor space. And while Finns can buy a home in a few years, UK buyers face soaring rents and fierce competition. Travel? A 500-mile train trip in Finland, £18. A 34-mile rush-hour commute in the UK, £31. Enough said. Yes, taxes are higher in Finland, income tax up to 55%, VAT at 25.5%, but they come with visible returns, free education, affordable healthcare, and reliable social safety nets. You trust the system here, says Darren. Higher taxes don't feel like a penalty, they feel like protection. And while the UK boasts a bigger economy, that wealth is unevenly spread. In Finland, redistribution ensures fewer people are left behind, boosting national well-being scores. Happiness isn't just about GDP, it's about stability, trust, opportunity, and peace of mind. Finns feel protected by their system. Many Britons increasingly do not. So the question isn't just why Finland keeps topping the happiness charts, it's what the UK might learn if it truly wants to climb back up. Under grey skies in sunny Cannes, Ireland made its first bold move at MIPIM, Europe's biggest real estate trade show, with the Island Strategic Investment Fund, ISIF, hosting its own investment pavilion. The goal? Attract global capital to help fix Ireland's deepening housing and infrastructure crisis. With housing completions falling to just over 30,000 in 2024, well below the 50,000 annual target, and development finance needs estimated at €20.4 billion per year, Private capital isn't a luxury, it's a necessity. According to a Department of Finance report, over 16 billion euros must come from international investors. The message from MIPIM was clear. Global investors remain interested in Ireland, but they want policy clarity, planning reform and consistency. Top investors like M&G and CBRE-IM have already committed billions to Irish residential and social housing, but delays in planning, rent caps and regulatory uncertainty have caused major hesitancy. One CBRE-IM exec admitted they're still not building on land bought in 2019 due to slow approvals. The result? A 24% drop in apartment completions last year, driven in part by Ireland's rent control measures. We need capital at every stage, pre-planning, PRS, student housing, senior living, said Elkstone founder Aaron Merriman. And we're not just competing with other countries, but other sectors like digital infrastructure and data centres. Industry voices are now calling for an IDA-style body to attract inward property investment, residential funds co-led by ISIF to crowd in capital, smarter incentives for long-term investors. At MIPIM, cities like London rolled out the red carpet with big-name pitches from Sadiq Khan and a clear £22 billion investment roadmap. Ireland's real estate leaders agree we need a sharper, bolder pitch to compete globally. As ISIF prepares to return to Cannes next year, the hope is clear skies, both on the Riviera and in Ireland's housing policy. More people in the UK now own their homes outright than those still paying off a mortgage, marking a significant shift in the housing landscape, according to new government figures. Key stats: 37% of households now own their home mortgage-free, 28% still own with a mortgage. Outright ownership has grown steadily over the past decade, up from 33% in 2013. Experts say this trend is being fueled by cash-rich homeowners who took out low-interest mortgages during the boom years, not out of necessity but for flexibility. Now, as those cheap deals expire, many are choosing to pay off loans in full. People only borrowed because rates were low. Now they don't need the debt, says Chris Sykes of Private Finance. Expect more to follow as sub-2% deals end. With more households insulated from interest rate hikes, some experts believe this is one reason UK house prices haven't taken a sharp dive. These homeowners aren't exposed to rising mortgage costs, so rate hikes don't hit the market as hard, says Nicholas Mendes of John Charcoal. What homeowners and renters are paying: average mortgage £758 per month across the UK. London mortgage £1,291 per month, up 17% year on year. Private rent in London £1,443 per month, higher than mortgages. North East mortgage just £520 per month. Despite talk of a landlord exodus, the private rental sector remains stable, holding steady at 19% of households. Rising rents may be keeping landlords afloat or encouraging tenants to share properties to manage costs. There's still a big mismatch between demand and supply, says Sykes. That's what's really driving rents. As we move through 2025, the trend towards mortgage-free living may grow, offering some homeowners peace of mind, while leaving renters and new buyers navigating a high-cost market.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.